Hey, greetings, Dr. Jeffrey Scott here, and this is my Market MRI Pro update for Tuesday, November 4th, 2025. Well, yesterday I asked the question about whether we should be worried about the cluster of Hindenburg-Omen signals, and I think today we got the answer. Um, one thing I learned a long time ago is technicals trump seasonality. Did Palantir wake up the bear? I think that's part of the problem. I think with the excessive valuation of some stocks in the market that maybe we love too much, including Palantir. Even Kramer was talking about it tonight. Not that I always listen to Kramer, but I was driving home and he was commenting upon just maybe got valuation got ahead of itself. So, question is, where's this market going? Is it is it going to go further down, and when's a logical place to expect a bounce? So again, my name is Jeffrey Scott, Market MRI Pro at gmail.com. My Google group's called Top Down Trader. MarketMRIPro.com is my website in progress. As always, everything I talk about should be considered education and not investment advice. The intent of the video is to demonstrate how I use my tools for top-down trading and analysis. Trading does involve risk, and you are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock mentioned in this report. Trading stocks and options should be considered risky, and you should consult with your financial advisor before making trades. I have tools in multiple platforms, and I'm actually now making some videos for the Metastock add-on, which will be launched in a matter of days or a couple weeks. Pretty exciting. Pretty exciting. Um, my Google group called Top Down Trader. It's a great resource. I do a lot of uh, members only things. I give discounts. When I'm on the road, when I'm traveling with my wife and we're in a little hotel room, I don't do videos because she can't sleep if I'm talking. So I do cuts and paste. I just post it in Top Down Trader. So go ahead and join. It's free. I mean, you get discounts. You don't pay anything to be part of it. Not a bad deal. News and earnings. Another day of what we should have had and what we got. We did okay today. Excuse me. We did not do okay today where we didn't get the trade deficit, factory orders, and jolts. On Wednesday, tomorrow, we'll get ADP employment, US PMI, and ISM services. So we'll get some data. It's got to be tough for the Fed. Clearly, the market feels like it's slowing down. And I think, as many people call it a K-shaped economy, AI up, everything else down. I think some of the turbulence at the top was masked by a lot of rotation. But today made me almost feel like we're not seeing rotation. We're actually seeing the market rolling over. From an earnings perspective, even stocks like Uber that had good earnings today rolled over. AMD this evening beat on revenue, beat on earnings, looked good, talked about the future, talked about how they were taking on NVIDIA, a lot of things that you would have thought that the market liked. And AMD is right now is down $13 from where it closed. So it looks like we'll have a bloodbath when it opens. Perhaps we'll have enough of a bloodbath when it opens, or the bloodbath will occur tonight that maybe we can put in a short-term bottom. But bottoms don't form near tops, and when you look at the indices, we're not far away from the tops. I pointed this out yesterday that when you look at when you get some of these big pullbacks, you almost get painted a line of the Hindenburgs. Um, I did a video not far long ago asking, should we be concerned about Hindenburgs on the NASDAQ? And on this one here, it was a NASDAQ that told me it was coming. And so maybe I'll resurrect that, find those slides and show you the research that I did. Now, one of the things that we do at my live meetings is we create a list. It used to be called the E-index. I think I called it the Praveen Dex this time because Praveen's my CTO and partner on the Market MRI Pro product. But we take the leaders in the market chosen by the attendees. We look at each one. We pick the best. We put it in a leaders index, an artificial index, and we look for it to break down. It broke today. I don't know if it broke down too far to be resurrected, but it traded down and closed below the 8-day exponential. Pull back to the 17 and a hold there, I'm okay with that. But a break much below that, and certainly a break below the 50, that tells me the market's coming down. And you could see the Hindenburgs on HGSI, not just on my product, are popped up a lot over the last several weeks. So we have had a lot of clusters. We also had what's called a kahuna, which is a pretty exuberant move to the downside. And this is a John Person friend of mine and a really brilliant educator, trader, money manager, author, and creator of some um, awesome tools. These are part of the HDSI add-on that he makes. A lot of things fire to the downside is my point. So let's take a look at all the data, the charts. If you have interest in Market MRI Pro, my process, want to talk about anything that I do, just email me at marketmripro@gmail.com. You want to talk to Praveen about issues with the program, he's at coding@marketmripro.com. Current users, um, big improvement. Um, we've now loaded it into the Windows App Store, and if you haven't, you will soon in the next few days or week get a link from Praveen. And what happens when it's in the App Store, it eliminates all the concerns that people might have had, when you install anything that doesn't that's new, that doesn't have a big history. Um, all virus programs are going to look at it and say we've not seen this before. Doesn't mean it's a virus. Happens all the time. A lot of programs that I install into my computers. But going through the Windows App Store makes it easy. It also makes it easy for upgrades and updates. So excited about that. Join Top Down Trader. Let's take a look at charts. So volatility was up 3.5%. Dollar was up 0.32. And as you could see here, all the major index ETFs were down. The only thing close to, well, it's not even close to break even. Diamonds are down half a point, closing at the midline. Everything else closed at the bottom of the range. Spiders down 1.19, Russell 1.73, and the Qs took the big hit, down 2.03%. Now, one concern has to be is what if the U.S. markets follow the Bitcoin down the rabbit hole? Bitcoin was down there 5.53%. And where the worst of the markets over the last 5 days is down 3%. And at least the other three, the diamonds, Qs, and spiders, are close to their all-time highs. Bitcoin's dropped 11.34% in the last 5 trading days, and it was down going into those 5 days. From a new highs and new lows perspective, new highs are going away. Looking at the 52 weeks on the NYSE down to 27 and the NASDAQ down to 40. Hindenburg in some ways is a self-healing test, and that um, once you start to sell off, you don't see any more Hindenburg omens. And the reason you don't see any more Hindenburg omens is pretty simple, and that's because you got to have 2% new highs and 2% new lows. And you're not going to get any new highs unless this market starts to recover. So minus 49 is the new high, new low on the NYSE, and now minus 91 on the NASDAQ. Not a good sign. Bull markets are not built on increasing new lows. If we look at sectors, industry groups, and percent advances, you could see on the S&P 1500, at least the sectors and industry positives look the same, but only 38% of the stocks were up. On the NASDAQ, deterioration and only 22% of the stocks were up. This isn't the NASDAQ 100. It's on the NASDAQ composite. And the NYSE composite, sort of a mix of the two on sectors and industries, but only 31% of the stocks were positive. This is not a bad breath day. This is a bad day in the market. Bad breath to me is a day when the market's actually trading higher, but the breath is not keeping up. And that, to me, minimizes some of the move in the market if I don't have um, the positive breath. Now, the other thing I like to look at is the volume today. And, looking at the volume on market surge, pretty much average volume. Um, the NASDAQ volume was down 1.28% from average, and the NYSE volume was down about 5%. Certainly not a big enough difference for me to say it was a meaningful difference. If you look at the S&P 500 sectors and you look to see what's working, clearly defensive day, financials, healthcare, staples, real estate, utilities. The exact ones you'd expect to see leadership. That means technology, discretionary, industrial were lagging. Interestingly, communications probably, you know, is being held up a little bit by something. We'll see. We will see it as we look through. But tech, bad. If you look at 5-day change, nothing is positive over the last 5 days of the S&P 500 sectors. If you want to see what's really lagging, it's where those leaders were. Look at, for example, uranium up 25% in the last 2 months, but down down 5.42 today. Metals and mining down 4.91. Blockchain 4.84, clean tech down 4.56, gold 4.54, copper 4.24. This is more than just a little pullback. This is a pretty brutal day. The only theme that was up today, that was barely up, was home building. Why? Because whether it's low rates cause the market to fall, or more likely, when the market falls, bonds rally and rates go down. But market got pummeled today, rates dropped, home builders looked attractive. So not a pretty picture. Let's take a look at the timing model. Here's the daily model, and you can see we're in a sell on the Russell. We're pulling into the WMA on the spider, the Qs, and the diamonds. All of them have flipped their daily bongo. So we are close to going to a sell signal. If we open down like we're poised to do right now, but hey, 9 o'clock uh, at night is 12 hours before 9 in the morning. There's plenty of time to reverse. But if we open up where we are right now, we'll trigger sells across the board. So it really looks like the short-term models are going negative. Now, the intermediate term weeklies are still positive. You can see the buy sell signals green and the bongos are still blue. And the monthly is a lot to learn here. Monthly still positive. Notice how these moves down are occurring within, remember last month ended right off the highs, and last month was 5 days ago. But you could see we're close to all-time highs on Spider, Qs, diamonds, and frankly, the Russell. So I guess if you want to be bullish, you could say, hey, we're having a pullback at all-time highs. Who cares? Maybe. If we look at the weekly charts, you could see that we've got, if they closed right now, we look like we're forming evening stars, bearish candle patterns, and a bearish, almost a bearish engulfing pattern on the SPY and the Qs, the diamonds. It's not a pretty picture. So how would I characterize this? Uptrend under a lot of pressure. Interestingly, a lot of the services that I read are still saying be fully invested, which I am not at this point. I'm not sure I would advocate that. Be nimble for sure. Um, I'm going to look for evidence that the market's ready to reverse before I'm going to start spending my hard-earned cash. Guppy charts still don't show any breakdown, which is good. I'm going to have this turned on for daily and maybe intraday soon so we can look at how that's deteriorating. That's starting to deteriorate. If we look at the USA indexes and we're looking at daily charts, just look at the spider because I think it tells the story. Here's a 17-day. We have pulled into the 50 before. This was probably the big pullback. We've pulled into the 17 a lot. We haven't even gotten to the 17 yet. So if you want to be bullish, that's okay. I'm bullish longer term. Great seasonality. We're just pulling into the 17, which all healthy markets will do. Nothing to be concerned about. Buy, 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 buy. I'm not so buy-ish right now, but I can see why people would say, hey, nothing bad's happened yet. This is normal. All right. How about the Qs? Haven't pulled into the 17-day yet. Normal pullback in progress doesn't mean we're breaking down. Could be. I'm concerned, but I got to do what the charts say. Diamonds pulling into the 17. And what did we do today? We pulled into the 17 and we bounced. All right, well, maybe that should make me feel better. What about the Russell? Oh, the first one that's failed us. It's broken down and closed below the 50. Still got good seasonality, so maybe this will be a short-lived hiccup. Um, it closed below the 50 here, and it massively rallied. All right, so we could certainly look for that. And you can see the next day gapped up and got back above the 50. So we'll see if that happens. Um, Maybe a little bit more concerning. If you look at this candle, what does it tell me? It's interesting. Yesterday, candle opened up at the high, traded really low, and almost got back to where it opened and gave us a bit of a hammer. That looked like it could have been a reversal at the 50. Today, we gapped down considerably, closed lower, and during the day tried to rally back up, and we failed. So you learn a lot from candlesticks. That's why I like to use them. I think we still got some challenges here. What did the VIX do today? You certainly expect the VIX to be up. We know it was up from the daily briefing. You see the volatility was up 10%. When the VIX is high, it's time to buy. When the VIX is low, we always joke and say, look out below because you're setting up for a market to fall. You just don't know when. The time to be, I think, the most nervous about markets is when the VIX is heading higher. And I think we'll be closely watching that. And then if we look at the dollar, we've talked about it for days now. At some point, this is going to spook somebody. And the dollar, which failed at the 200 for a long time, has broken out, has now had 1, 2, 3, 4, 5 days up in a row, gaps forming, most days closing higher than the open. Now, I've been sort of negating my concerns, and part of the reason for that is we got a gap here, and we know gaps like to fill. Are we going to run back up into that area and then potentially come back down? That's possible. And also don't forget how far off the highs we actually are. Deteriorating picture though, any way you look at it. Let's look at the commodities. Gold has pulled back, as have silver. You could certainly target the 50 there. And what they're doing certainly would not shock me to see the major indices do, which is to pause for a few days at the 17 and then pull into the 50. Now the question is, will we bounce there? Speaking of bouncing, oil is trying to bounce off its recent lows, but it's really running into a lot of resistance. You got the 50, the 200, and you got trend line. Yesterday I talked about how maybe it was time to buy UNG or to start looking at some of the companies that are going to benefit from selling our natural gas or liquid natural gas outside the US. And I think UNG is one of them. If we look over here, we can look at the 10-year and the 30-year. Let's blow them up. Why was construction up? Because look at the 10-year, it was down 0.5%. Now, that wasn't down 0.5% on the yield from a 4.0 to 3.5, but it was down 0.5% from it was down 0.5% from the prior close, which means it was down today to a close of 4.09. Now, is that good or bad? It's interesting when the rates are falling, the market seems to um, not be happy. So maybe it's bad at this level. If we look at the 30-year, something that I follow closely, you could see it ran into the 50, it failed, and it too was down in the markets on Tuesday, down also about 0.5%. So lower rates could be good for the market. Stronger dollar, probably not good for the market. The question is, are we closer to the end of this pullback or just in the beginning? And for that, I need to look at my various breadth tools. One breath tool I like are the buckets. If you take the Bollinger Bands and divide it up into 10 slices, percent B, 10.1 of percent B per bucket, you could see that most of the stocks are in the lower part of the Bollinger Band. The white represents the stocks underneath the Bollinger Band, and over here, stocks above. Now you can see 17% of the NYSE is below the Bollinger Bands. 20% of the NASDAQ are below the Bollinger Bands. 16% of the S&P 1500 are, and 19% of the Russell. I will tell you that's a good number. It shows you the weakness in the market and that we're probably getting in the ballpark to see a reversal, but I'll show you what a bad number is. And, kudos to Praveen for making this so easy. Just to go back to April 7th is when I called the bottom of the market. I pick the date, hit the little green circle thing, and it'll show you what bad looks like. That's what reversal time looks like. 76% of the NYSE below 52% of the NASDAQ, 66% of the Russell 2000, and 79% of the S&P 1500. It doesn't usually get that bad. 35%, 40% of any of these, and I'd be looking for a reversal. Just got to touch that again here and go back to today, and then touch the green, and it'll move it back up. Market breadth, very important to me. And on the left is the NYSE, on the right is the NASDAQ. And you can see we have broken below the 50 on the NYSE. Concerning, yes. Will the rest of the markets follow? They might. They might not. I'll be watching that very closely. Here are some of the things that I look at. Stocks above the 200-day in red, the 50-day in white, and the 17-day in green. This is a divergence when the market's going up and this is going down, and we clearly saw that up here and down here. Now I'm looking for excessive. So is this excessive? No. Let's squeeze this so you can see what it looked like on April 7th when I made my call. 4% of the stocks above the 20-day, 7 above the 50, and 15 above the 200. 4, 7, and 15. Where are we right now? Nowhere close. 33, 33, and 51. So that's not going to give me a break and tell me that we're going to reverse tomorrow. We can look at the same thing over here. If I scrunch it up, I'm not going to go through the numbers, but you got to go back to the prior low and compare where we are. We haven't even started rolling over yet, is the point I'm making. If we look at the current bar, here you can see up, down, excuse me, new high, new lows, negative, AD lines on both negative, up, down, volume, negative. No new Hindis, but this is the cluster that concerned me right here. And if you watched enough of my videos, you know that when we break below the 50 after Hindenburg Omen is when I personally start to raise cash a lot. Now, because I've had a happy return this year and I want to keep most of it, I'm in more cash than I think I ever am going into November. And I also put puts on my big positions. So I want to end the year plus. I want to end it plus triple digits. So I'm being very defensive, but this break below the 50 gets my attention. And you know what? If I'm wrong and we rally back to new highs, I'll be long, long before that happens. We're not going to go there in one day. And also remember, as we potentially are moving into a bearish stance in the market, some of the best rallies occur when the overall market's still going down in a bear market. All right, there's another market breadth tool I use. It's over here. And the other thing we're going to look at is this number here. 0.25 is the 13-week new high, new low today. Notice the bar even turned up some. That is on the spider. On the NASDAQ, it's 0.15. It's 0.24 on the Russell, and it's 0.22 on the S&P 1500. Similar to market tops, I look for extremes. Now, if you go back to that April date, which is going to be right in here, and you look at what those numbers do, you could see we're at 0.01 here. We are similar on, that's the 7th. Is that the 2nd or the 7th? Let's get to the 7th. You can see we get very close to the 0 line. And so Um, we're not there yet. If you look at, let's go back and there we go. You can see the AD lines are still going down. No surprise. You want to look to have those start coming up before the market turns up. Give a positive divergence. The RSI is falling hard. I don't see a signal that we're imminent on to see a reversal. Now I run a large list of stocks looking for divergences, and we're now starting to see more green than red on that list, and so that's a positive. But the reality is, um, divergences like extension can go on for quite some time before they resolve in the direction that they're going to resolve in. So I note those divergences are there, and they're starting to be green instead of red. That makes me feel good, but doesn't mean we're reversing imminently. If we go and just for grins, I created a, and it shouldn't say, here it is, intraday timing model. So I'm curious if my model would help me on an intraday basis. So I'm looking at an hourly chart here. And what's interesting is when you really get down to the really, really short-termer time charting, we have been in a sell on the hourly since the 29th. And the 29th, it was that Wednesday last week. Let's see. On the best with dates. So let's look at it. Yep, Wednesday last week. And we've been persistently in a downtrend, at least on the S&P since then. And we were entering a sell signal on everything except for the Qs at that point. Qs happened a little bit later on the 29th. So I think we got to be careful here. That's a theme today. Don't be a hero. Be careful. You'll have plenty of time to make your money back and to build your nest egg. Been doing this for 30 plus years. I've been through dot coms. I've been through flash crashes. I've been through the financial recession. I've been through COVID. I've been through taper tantrums. And I know how my gut used to feel in these pullbacks. And it felt that way because I didn't have enough experience to know what to expect. And I was too invested at the top. So I've learned to take profits as we come to the top, build up my cash position for when the market rolls over. But one thing I've learned is the greatest rallies occur after market pullbacks and bears. So I don't want to overtrade. I'm not going to overthink this. I'm not going to overplay this. I am going to look for opportunities to the short side and the long side here, but I'm going to keep mostly in cash because I don't want to be a hero, and I want to have a lot of money on the side because just like on April 8th, when I went in the market aggressively, and I'm not going to repeat my performance, but I did it at the end of the month. I reviewed my performance. The market return off of bottoms can be 100% per month. So, but you got to have cash left. Ratio charts are something that I like to look at to give me a sense of the rotation in the market. And you could see tech, which has been leading this long red line, says just steadily down today. And we're going to see how far it drops. And you'll see that things like healthcare had a nice bounce today. Utilities is going to be mixed because so many of the utilities are involved in energy generation for the data centers. And my favorite are the Bitcoin plays like IREN that are now data center plays. Crazy. Real estate popping up a little bit, staples up a little bit as well. But this has been a market led by tech. Now, look at what happened to Bitcoin. Ask yourself what happens if we see that in tech. If this AI bubble pops, where does AMD go? Where does NVIDIA go? NVIDIA earnings are not to next week. And then think of all these small companies and cloud and the AI space that have no revenue and no earnings that are trading at huge multiples. That's what I would be worried about right now. If I go into the JAS layout, this is my stock picking layout. I don't even want to pick stocks today because I don't think I want to, again, be sitting here telling you anything to go long tomorrow until we see what the markets are going to do. You're going to get a bottom. The question is when, And it seems to me that tomorrow's too early for that bottom to occur. Just my guess. Um, if we look at my top-down group, well, first of all, you can see we still had 3,800 stocks in my data set. Go into the top-down group, and now we're looking at very um, diverse and robust sectors with 3,800 stocks put in their appropriate sector and industry group. So it's not just the big caps. It's a very broad look. And you can see leadership today, staples, real estate, and healthcare. Um, we already talked about that with the ratio charts. If we then do percentage change on the industry groups, and we want to see what industry groups were leading today. Oh, here we go. Come on, there you go. Medical devices, distributors, we know which ones those are. Drug manufacturers, healthcare plans, one, two, three, four. Medical, discount, REITs, and agricultural farm. I tell you which group sector does the best when markets are turbulent. It's healthcare. Why? Um, I mean, I've been very fortunate. My mom made me go to med school. I practiced enough until she said that she was happy, and then I quit and I became a businessman. But all my businesses have been in healthcare. And the nice thing about healthcare is it doesn't even know what a recession is. Now, that may not hold because we have a healthcare crisis in this country. Expensive, too big of a part of GDP. We're not the best in the world, and something's going to be done. And when that happens, a lot of the companies in the healthcare space are going to be pressured. But I will tell you the conversations have been going on for 20 years, and we're still here today. If we look at these 10 groups here, and we then just go down here and look at percentage change, and let's just take out the teeny ones. $5 and 500,000 minimum. Hit OK. Got 155. So we've got some big movers. I don't usually spend much time on these because I don't know them. Davis Commodities Limited ordinary shares. Uranium was down. It wasn't a great day for commodities as the dollar was up. You might want to do research on that. Probably not chasing that. Um, Tactile systems, don't know this, big gap up. Now look at the volume, look at the 2-day momentum coming out of the squeeze. That's pretty impressive. I might come up here and say earnings. Earnings came out. 125% surprise, 73% growth. Revenue was up 17, but a negative surprise. Trades at a 12%. Well, what do? Highlight that. Medical tech company engaged in development and provision of medical devices for chronic diseases. Flex Tech Pulse, a pneumatic compression device for treatment of lymphedema. All right, niche market, but somebody must like them. Big move. And if I don't know what's going on from the fundies, I can go click here the newspaper and see what's up and increase their forecast after better than expected earnings. Well, that's a story that typically breeds further success. Problem is it went from a 6% gain, so it went from 16 to 22 in a single day. That's a pretty big move, but that might be one to take a look at. CSTL, Castle Biosciences. I mean, I don't think this company has revenue. It does a little bit of revenue. Um, Earnings came out. Again, a surprise on both earnings and revenue. That's probably what's driving it. If I look over here, earnings call, third quarter result, increasing cash flow. Could be worth taking a look at and reading about. All you got to do is click over here on any of these articles, and that'll bring it up so you could take a look at it. AHCO, is this adaptive? Let's look at the home medical equipment, medical supplies in the United States, sleep apnea treatment. Okay, CPAPs and PAPs. Again, earnings out, growth rate at 19%, turned positive. Earnings revenue growth as well, multiple of 5.98. Maybe that's what's driving it. VITL is another, this is, I think, eggs, and this one's down in the pattern with a big rally. It's just not a pattern I like to buy. I like to buy high to buy higher. INSP is one that has a similar story. Earnings were out, big surprise on earnings, not a surprise on revenue. Um, it's had these pops before and it comes right down. Might be worth looking at, watching it. BVS, BioVentures, what do they do? Highlight medical device company, natural healing process. Okay. Didn't take out the 200. I'd like to see that happen. So you could go down there. Here's one of my old time favorites, Tandem. Um, we talked about it here. It's pretty much gone sideways. This is one that historically I've played pretty well. I am not in it right now. Now, the challenge of looking at it this way is you're going to find one day wonders. So sometimes I'll just look for 2 day moves, 2 day momentum. And what'll happen is the percentage change drops and we might get better looking stocks. IDXX, an animal health company, big move yesterday on Monday. And on Tuesday, it really didn't give up that much. In fact, it was down less than a dollar, 0.1%. That's kind of interesting. IDXX had a surprise on earnings and revenue. Animal health, we take care of our animals even if we can't afford healthcare insurance. IDXX, expensive stock. WAT, Waters Corporation, big move up after a pretty significant fall. And again, earnings came out. And when you see red and you see the stock going up on earnings, it makes you think their earnings were better than was expected. Um, all right. And you could go down the list. TCMD has been on my list a number of times of late as it's had this beautiful move. Big gap up today on response to earnings that came out yesterday. Look at the surprise on earnings. Um, Great earnings per share growth, a multiple of 12. So stocks with good earnings are being rewarded. Lilly, the maker of one of the GLP-1s, Mounjaro, the stock was hammered because of competition, but earnings came out this week. Look at the earnings per share growth change. And yes, they had a surprise, but that was, what were they projecting? 400%? A surprise on earnings and revenue. How high will this thing go? The next earnings are going to be $7.20 versus 532. So that's up about $2. It's a 35% increase. It has a dividend that's teeny weeny, $6, but less than 1%. Trades at a multiple of 31.49. But my favorites, I think everybody knows my favorites in this market. McKesson, on days that the market does great, you're going to get a pullback because this is sort of a defensive play. And if that doesn't appeal to you, um, let me ask you, does this um, appeals to me? Now, I wouldn't go out and buy it yet because it's got earnings tomorrow. And I think these might be before the open. And so maybe you'll get insight into their earnings and maybe if their earnings are fine, especially if this market, if you have to be invested and this market does horrible, McKesson, Cardinal, and yeah, I don't know when the earnings are, and Cencora are stocks that I like to be in rough markets. You can see Robinhood tomorrow afternoon. That'll probably be the one that generates a lot of interest on the street. It sold off a bit today as well. So that's McKesson. If I look, I'll find Core. This is Cencora. And again, look, you want to talk about steady. Look at earnings per share growth, steady. Look at surprises, steady. Look at revenue growth. These are just great companies. What a Actually sold a couple companies to Cencora when it was known as ABC and still friends with the CEO. Brilliant, brilliant guy. These are the best operators in the world, in my opinion. I've worked for two of them. I sold a company to Cardinal Health as well. And these companies rely on teeny weeny margins. And I think they provide so much value. And I won't say that about every entity in the healthcare channel. But since I work with them, I'm going to keep my mouth shut. But I will tell you, I'm a big fan of operating excellence, and you get that from distribution. So, from a top down perspective, here's Cardinal, the other one in this family. And oh, yeah, market did bad. Look what this did the last 2 days after good earnings. Um, so, I'm not advocating you buy stocks tomorrow. I think you wait and see what the market, some of us have to buy, we can't help ourselves. Um, and there'll be something that's looking good, whether it's an earnings response from today or maybe the market turns around before it opens and you'll have opportunity. But sometimes I will go look at bottoms up to see if I can identify anything that looks good. I go to the impulse and I'm going to do a very quick analysis. I'm going to clear my filters and I built in two secret weapons. One's called A plus. This requires a double momentum signal buy, and you had two. Henry Schein, which is another distributor in healthcare, obviously a very different pattern than the three I just showed you. Jumped on earnings beat. Of course, earnings came out today. That's good. And you could see, unlike the others, they're a little more volatile on their earnings per share, not always green. And then TCMD we looked at before, and I think this one does look interesting. Great seasonality, broke out above the 200, massive volume. That's a weekly, my bad. Go back and look at the daily. The gap sort of kills that chart. Let's look at HCSIC since I forgot to take off the weekly again. Done that a few times. Yeah, it took out the 200, a big gap up. This one just isn't, in my mind, in the same category as the other three. And TCMD looked better on the weekly because you didn't see the gap, but look at the double momentum coming out of a squeeze. Look at the strength, the relative strength at OBV. Is it getting too extended to buy? Yeah. So I probably wouldn't chase that one either. The other quick one I put in is my A trades, which require the stock to be in an uptrend, and it requires to have a squeeze. Let's look at one, BVS, which is Bioventus. It requires you to have the squeeze, to have at least a momentum or a breakout signal, relative strength to turn up OBV. Is this an earnings story? Earnings. And they don't even look that good, which means they weren't as bad as people thought they were. Um, CMPS, I think Compass Pathways, don't know what they do. It's in healthcare. Maybe I should know what they do. So all I got to do is hit that, and I don't have anything, so I can't tell you. Big move up, pull back to the 50 at a breakout. I like that pattern. Again, I'm just not advocating going out and buying a lot. Simon Property Group. This was an interesting. Um, they own shopping centers and malls. Is this a positive time for that business or not? Um, I bet they pay a nice dividend though, and they do. It's 4.71%, and they make money, and they have steady revenue, not a ton of growth. So you're probably buying it for some capital appreciation and and for that dividend. But I'm not sure I want to be going all in on shopping centers if we're going into a recession. Now, when the recession happens and they pull back a lot, then talk to me about going all in. And then there's that tandem, which I mentioned before. And again, too low in its pattern, but it looks interesting here. It's definitely in an uptrend, pulled back to the 50 and popped up here and met the criteria for the scan. So I'll summarize by saying danger, Will Robinson, danger from my growing up and watching Lost in Space. I guess June Lockhart just died. I think that's who was the woman there. I think she just died. Um, that was when I was probably 5 watching that. But I think this is a dangerous market, and I heed the Hindis. And I am, as I said, I raise cash. Will I go into the market? I'll have to have a good reason. I want to see the markets pull back. I want to see those buckets build up beneath the Bollinger Bands. I want to see that 13-week new high, new low pull down into the single digits. And then I want to look for a follow through day after an attempted rally, sort of a Bill O'Neill type of a system to look for time to get back in. Have a great day in the market. Be careful. Don't be a hero. You'll have plenty of opportunities to make back whatever money you lost today.